But honestly, actually, the value of your house goes up and down. The value of your car goes up and down. You just don't see it because there's not what they call an efficient market sort of reflecting that value constantly. Even your value on the job market goes up and down every day. But the Oh, let me turn this off. Sorry. The financial markets can be confusing because they just give you so much information, and sometimes all that information can distract us. But ultimately, it's really about stabilizing the value of the stock so that you then have that ability to generate your income and maintain some degree of consistency. Now, just so you know, I'm going to answer all the questions you guys submitted in advance first. So if you're putting a question in the chat, I won't see it for a little bit because I'm literally looking at one screen here on those of you that submitted your WUFU form. So if you log in at drboyceprime.com and you look for that form on Ask Dr. Boyce, just where you can submit questions, these are the questions that I'm answering. I want to make sure I get everybody's question answered because I know some of you had questions during class that we couldn't answer. Let's see. Steve says, with selling a call option, the strike price should typically be 3 to 5% above the stock price. That's what I believe. I'm not telling you what to do, but that's what I like. What is your recommendation in terms of the amount of time the option should be when starting out? I sell weekly options. I plan on starting with a $10,000 capital base. Yeah, I think that a person that has $10,000 sitting to the side could easily make $1,000 a month or more from their business, and by basically following that rule, the three to 5% difference. Make sure your puts are secure. Choosing the puts based on what we talked about in class. Weekly time frames, picking stocks off the moneymaker grid. So I grab them, I put the moneymaker grid. The latest moneymaker grid is in your login at drboyceprime.com. So all the stocks in the moneymaker grid can give you, what I think is a solid ROI. Again, I'm not here to tell you what to do or not what to do, but I can say that with a $10,000 capital base, let me see here. Yeah, yeah. I'm just looking at, some of the stocks that we talked about. Like if you look at, for example, a stock like Affirm, and if I bought, I don't know, 200 shares of Affirm, that would cost me about $8,600. But then I'd have to make sure I get the right puts to protect my investment. And so if I was buying a put on that, I buy a really good put, like it with a strike of 40. And to protect 200 shares, you would need two contracts. So that's an extra $1,200. So you put up 8,600 and for the stock, 1,200 for the puts. For the stock, really, though, actually, you don't have to pay the full amount because you would pay half of that. And then at that point, you can sell your weekly call option. And let's see, for a firm price of 43.50, if I picked a strike price that was 3% above, 3 to 5% above the current price. Let's see. Let me do the math in my head. Let's be conservative here. Let's pick a strike price of 45.50 on those two contracts. And I haven't even actually used up all the money yet, actually. I haven't used any margin here, actually. So let's see what happens if I don't use any margin. So let's pick this put here. All right. So two contracts. Yeah, yeah, yeah. So a person applying that strategy could actually, I said 1,000 a month, but that's super conservative. Actually, it's more like 2 or 3,000 in a month. So yeah, if you've got an extra $10,000 saved, and you will apply the techniques that we teach in class, and you apply them carefully, I don't see any reason why. I would not be surprised if you made $2,000 or $3,000 a month. And the thing that you just always want to kind of keep in mind is we talk a lot about market fluctuations, and so the more puts you buy, the more you minimize the fluctuations. But even then, you're still going to have some ups and downs, and so you got to kind of know the difference between the different kinds of losses. You've got realized losses, unrealized losses, and FOMO. So paper losses are unrealized losses.